Hey, welcome again. I appreciate you following and checking the series out. We started the series with a top 5 business steps to do when starting a new business. If you haven't seen that, go ahead and check that out. It's worth the look. And what I want to do right now is I want to go over the top 4 business deductions that we see on our end, on the accountant's end, that we see that is either being claimed wrong, filed wrong, causing that infamous red flag issue that some people might stop. But I'm going to split this into a 4-part mini series here that's on the series because I want to put these down in shorter clips. That's not lengthy. The full presentation is, I'd be lucky to get it under 20 minutes. So I want to make sure I put them in smaller clips. So again, don't forget to subscribe here, the TBS Strategy on the YouTube here. I have tbsstrategy@gmail.com is where you can email me and email me directly. I check it all the time and I answer questions on there when I can. And if you have any video requests or anything you'd like me to throw up there, you let me know and I will take care of that for you within reason. Also, you can follow me on Twitter at TBS Tax. So Total Business Solutions, TBS Tax. So let's get to it. The first one of this 4-part series we're going to go over is meals and entertainment. Meals and entertainment is a huge one. So let's put it up here. Meals, entertainment. So that's long. Seems like it's really long. So we have basically 2 different kinds of deductions here. We have 50%, most common, but we also have 100% deductibility, and I'll get to that and what that means. Let's start with the most common because most of the rules are going to be based around this. 50% is the rule. Now I want you to keep in mind that you give your accountant or tax person the full amount, and the tax software or tax return itself actually takes away 50% of the deductibility of it. So, meaning that the IRS believes you get personal benefit on this as well as professional benefits, so they're going to take out 50% for personal benefit on this. So, the 50% rule is as long as you expect to discuss business before, during, or after said meal and entertainment, then it's deductible. So that's the first rule of making your meals deductible. As long as you expect to discuss business before, during, or after the meal and entertainment. Now, this could be dinner with the spouse. It's possible. Keep in mind, though, once you start commingling in some more personal benefits, you're less likely to get the 50% deduction. So you have to be careful here. In my case, my wife works for me here. So if we go out to dinner and because we need some time away from the office to discuss our next strategy for the next day or the week coming up or something busy happening or a new move we're making with the business, that makes perfect sense. So if we take the kids, though, that could be a whole different ordeal. So because the atmosphere has to be conducive to discussing business. So conducive to business means that you're not going to be standing in a rock concert discussing business. It's entertainment. You could be taking a client to that entertainment, but the IRS is likely to say that that's not going to work because it's not conducive to discussing business. So you have to now. So if, back to my earlier example, if the wife and I take the kids out to discuss business, it starts to then get a little sketchy as to whether we can use that or not because there will be some business discussed, but there will also be heavily weighted in personal. So you have to be careful how you arrange that. Now there are ways to arrange that properly and to still get the deduction, but general rule of thumb is you have to watch out to make sure the atmosphere is conducive to discussing business. That brings us to the piggyback rule. You can piggyback on top of a viable meal or entertainment with something that's less conducive to discussing business. So, say you took a client out to dinner, you follow the rules of before, during, or after, you understand, and it's conducive to discussing business, and then afterwards, you take the client to a movie where you're not going to discuss business. But because it was in conjunction with an actual viable meal, then the entertainment then becomes a piggyback expense on top of it, and therefore, even though the entertainment wasn't conducive to discussing business, it will still count because you attached it to something that was. So, if that makes sense. So the piggyback rule applies, something like that. So you can go to that concert as long as you did your meal before or after that concert and actually had some business, and then you could treat your client out to a fun event where it's not conducive to discussing business. So it makes sense. And then actually, the next thing is 5 journalists' questions. So the 5 journalist questions we're familiar with from school is the who, what, where, when, and how. What you have to think about here is even though the IRS doesn't require you to save receipts for anything that's under $75 in value for the meal or entertainment, I always encourage everybody to save as many receipts as they can, because in this situation, the receipts give you proof. If you're paying cash or things like that, you always want proof. You want to make sure that you can find it if you're ever asked. And the 5 journalist questions are required by the IRS to actually be answered, which means who were you with, what was discussed, where was it, when was it, and how much was the price. The receipt answers 3 of these. 3 are on the receipt. So with that being the case, the 3 that are on receipt is where were you, when were you there, and how much did it cost. So the only thing that you have to kind of jot down, the receipt is an easy spot to do it when you sign and you take yours home. If you were taking your friendly neighborhood accountant out to dinner, you would say something like, Jason, taxes, or accountant, taxes, something like that. You answered all 5 journalist questions, and you're great. So these, again, general rule of thumb. There are some exceptions that apply, but this is how you'll see it. The next, and then for as far as the 100% goes, our last subject matter here is 100% meal are anything that is sustaining productivity in the business. So a perfect example is here during tax season. It's really busy. We are taking care of a lot of people. We have too much to do and too little time to do it. And everybody's working late, and my employees will starve themselves at their desk in order to not leave a current project because they don't want to come back and try to figure out where they left off. So I will buy a lot of meals in so that they can sit at their desks and work and it just limit their frustration. Now those meals are 100% because they are actually sustaining productivity in the business. If I do a lot of seminars where I'll be out at a venue outside of my location here, and there I will either cater, I will bring, even if it's just coffee and donuts and bagels in the morning, those are all 100% deductible meals. Meals and entertainment, entertainment that's conducive to keeping business would, maybe I bring in a chair masseuse to come in and give my employees massages while they're working at their desk, and that will sustain productivity and bring in some entertainment and kind of break up the day. So those things are 100%. You want to, when you're doing your record keeping, you want to keep them separate. You want to make sure that, because if you just hand your accountant a bunch of receipts for meals and entertainment, they're going to put them all into this one. And this is the one that's most widely used. And then you're going to lose half your deductions on any of these things that you do that are actually sustaining the productivity of your business. So you want to make sure that when you're recording them, you take meals and entertainment and you separate what's 50% and what's 100%. So now, managed to get this under 10 minutes. I'm pretty happy about that. And look forward to the other 3 that I'm going to go over, which is going to be your automobile, your home office, and your travel. So once again, follow me on Twitter under TBS Tax. You can email at tbsstrategy@gmail.com and follow me on YouTube, subscribe on YouTube at TBS Strategy here. So please feel free to comment and email, and I look forward to hearing from you. And I will give you the other 3 parts of this series as promised. Thank you and have a great day.